gold doesn't rise because it's in a bull market. It rises because fiat money's in a bear market. And that, just simply isn't going to change. It hasn't changed. It certainly hasn't changed yet. And so 2024 was, again, not totally easy to see, but fairly accurate. And to your question now, on 2025, on the markets, I'm less bullish. Rate cuts to me were a sign that despite not hitting target inflation and not beating the inflation, taming it, that rate cuts were a desperate move at the same time. So it was kind of bipolar, but it certainly was a tailwind for the markets. But rate cuts were also a tailwind for gold.
Gold is off to its strongest start in the new year since 2023 and is on track for its best monthly performance since September. Last week, gold hit new all-time highs in euros, British pounds, Canadian dollars, and Swiss francs, signaling that the precious metals bull market is poised to continue. This week, persistent inflation and rising economic uncertainty, compounded by increasing government debt, drive gold prices towards fresh all-time highs, surpassing $2,800 per ounce. MatthewPiepenburg of Gold Switzerland shares his outlook for gold and the markets in 2025, explaining that gold doesn't rise because it's in a bull market. It rises because fiat money is in a bear market. And that won't change. It certainly hasn't yet. He also warns that while rate cuts boost both markets and gold, they ultimately signify desperation. Looking ahead, the Federal Reserve's position on interest rates remains crucial, as its decisions can significantly influence the direction of gold prices. With the first Fed meeting of 2025 approaching, many investors wonder whether gold's rally will persist or if potential headwinds could slow its momentum. For 2025, Piepenburg is less optimistic about the markets, pointing out that while Powell's dovish stance remains, there is now more cautious language regarding potential rate cuts. He attributes this shift to debt-driven crises, particularly sovereign debt crises worldwide. Piepenburg believes this trend will persist, reinforcing gold as a dependable hedge against the ongoing challenges faced by fiat currencies. We're about to explore the video, but first make sure to subscribe and hit the bell icon to keep up with our newest uploads. Your feedback in the comments is always appreciated.
Despite kind of having fundamental problems with this market bubble, but the Fed was clearly signaling a dovish 2025. And my simplistic reduction of how markets work is when a central bank is dovish, markets tend to rise, and when a central bank is hawkish, they tend to retract. And last year at this time, it was fairly obvious from November all the way into December and January when we met here that Powell was throwing in the towel on rate hikes and going into cuts, which is precisely what happened in 2025. It wasn't in 2024. It wasn't until later in the year, but it was already signaling. And the market, again, being Pavlovian, just the carrot dangling of a rate cut got markets galvanic and hopeful, and it was a tailwind, and we saw a pretty decent year in the S&P as expected. But again, rate cuts to me were a sign that despite not hitting target inflation and not beating the inflation, taming it, that rate cuts were a desperate move at the same time. So it was kind of bipolar, but it certainly was a tailwind for the markets. But rate cuts were also a tailwind for gold. And so obviously gold hit nominal highs in many currencies, including the US dollar. It's over 27%. And in the Eurozone where I am, it's over 33%. And the Swiss franc, 36%. So obviously a very good year for gold. Again, that wasn't just market genius. I wasn't alone in that. I certainly was bullish for both, which is ironic because usually I'm very cynical, and I still am cynical about markets, and we could talk about this year. But, again, with gold, and we'll get into more detail, for gold it's always simple because debt never changes, and there's a debt collapse driven by sovereign debt crisis, not just in the U.S. but globally. And gold doesn't rise because it's in a bull market. It rises because fiat money's in a bear market. And that just simply isn't going to change. It hasn't changed. It certainly hasn't changed yet. And so 2024 was, again, not totally easy to see, but fairly accurate. And to your question now, on 2025, on the markets, I'm less bullish. Again, not just the Pavlovian, see what the Fed does. Already, Powell. It is fascinating, by the way, that we have to spend so much time talking about a central bank to discuss markets, because technically, ideally, we should have natural supply and demand, free market discovery, fundamentals, balance sheets, price to book, price to earning, a basic Benjamin Graham Buffett analysis of markets. But what we're really talking about first is the central bank. And again, as in this year, Powell is still dovish, but moderately dovish. He's talking about rate cuts, but throwing out the possibility of less rate cuts or even a potential rate hike. Just that kind of moderate language as opposed to strongly dovish language. That is already a signal that the markets are a little curious or concerned. Again, it's not the only factor. The other thing that's really amazing after this year with the S&P, and again, the contrast of the market with the real economy is appalling, and we can talk about those recession indicators, but regardless of the Main Street economy, which is just a working poor disaster, in a lot of ways stressed by years of higher for longer, but regardless of the economy being poor, there are certain basic indicators that are gravity defiant for only so long. And again, they're simple, stupid, but the Buffett indicator, market cap to GDP, S&P to GDP, that's a classic indicator, and it's at all-time highs. And not just the indicator itself at 204 or 208, those come in rare moments, and usually those peaks are followed by significant sell-offs. So the potential for gravity and mean reversion reasserting itself in the markets is more real this year than it was a year ago. The fact even that Buffett himself is so heavily into cash is a leading indicator of risk off too. That's different from last year. There's another indicator that I used to use certainly when I was trading risk assets is the S&P to currency in issue. And that's another ratio. You can find the charts. It's also nearing all-time highs. These are kind of large-scale, obvious, simple, stupid, I'd say, indicators that this market is really, really overvalued.
The strength of precious metals comes amid growing economic uncertainties. The Congressional Budget Office recently released its economic outlook, highlighting a significant rise in U.S. federal debt over the coming years. According to the report, the federal budget deficit for fiscal year 2025 is projected to reach $1.9 trillion. When adjusted for shifts in payment timing, this deficit is expected to grow to $2.7 trillion by 2035. As a percentage of GDP, the deficit is forecasted at 6.2% in 2025, gradually declining to 5.2% by 2027 as revenues outpace expenditures. The CBO also warns that the debt-to-GDP ratio could surpass the post-World War II peak set in 1946 within the next few years, underscoring potential long-term economic risks that may drive increased demand for safe haven assets. MatthewPiepenburg emphasized that, despite the buzz surrounding technological progress and markets such as crypto and tech stocks, gold continues to serve as a reliable hedge against fiscal mismanagement. He clarified that gold doesn't appreciate in the same way other assets might. Instead, it acts as a store of value in a world where fiat currencies are steadily losing their purchasing power. Now, let's redirect our attention to a video.
I am a broken record, but sad. Gold it's easy for me because the rest of the world just keeps continuing to make the same mistakes, and governments continue to make the same desperate mistakes. Hopefully there'll be a change at some point, a tipping point. But as long as the world and governments continue to run deficits like they do, and right now we're the fiscal quarter or the fiscal calendar for America starts in October. And so we have October and November numbers. We're already $690 billion in deficit this is the fiscal year that Trump's inheriting. I mean, that is insanity. That's where we were at COVID. So we're spending a deficit spending as if we were in World War II at the same inflation-adjusted, currency-adjusted numbers, but we're not at war. The reason we're running deficits is we simply have the GDP and the tax receipts, so we're going to monetize that with liquidity, fake liquidity, which is inherently inflationary. So your question about gold, this is just an example of the debt disaster that our budget is in. Regardless of Elon, regardless of Vivek, regardless of campaign rhetoric, those are facts. You can have your own opinions, but those are facts. And those facts tell me that we're going to need to synthetically support this broken debt market. Again, everything starts with the bond market. It all comes back to debt. And unfortunately, the policies to do that are going to be currency debasing policies. So again, gold doesn't rise, fiat gets weaker. It's certainly true even in the home of the world reserve currency. That's going to be true in all major currencies. And so since 1971, all the major currencies have lost 99% when measured against gold. So for me, it's not that gold rises, fiat money gets weaker. It's not sexy, it preserves money. I look at dollars, Canadian, American, South African, Australian, they're just ice cubes, beautiful ice cubes that are slowly melting. Whereas gold, boring, not so sexy, holds its value, and actually can go up in price appreciation optionality in this kind of market like we've seen this year. It's outperformed the S&P, which was at a blowout year, and it's still outperformed. But again, are you not entertained? Gold's not doing enough. It's a very misunderstood asset. But we who understand gold for preservation purposes are certainly happy to see the speculation benefit or the price appreciation benefit, but we're not speculators. And it sounds very smug, and I know for a lot of people that are worried about getting through the month, this doesn't help them because they're trying to get growth and they're trying to get return. The vast majority of my clients or our clients are in the stay rich camp, not the get rich. You can take your risk elsewhere. You can take it in crypto, you can take it in Nvidia, you can take it in tech, you can ride the roller coaster of volatility and stomach churning vol. Or go long some tech thesis. But it's for gold and our clients in 90 countries, I never get a phone call asking about the price because we just know, not smugly, gold just sits there and holds its value while fiat money is very busy losing its purchasing power. So we're very, very strong on the preservation camp. Speculating in gold is very difficult. In the futures, the options, you have to be pretty good at that. And you can, but we're not. And because we're not speculators, we're almost too confident. Gold, of course, doesn't go in a straight line. Of course not. But we do know it outperforms fiat money in the long term without exception, just because central banks are our best friends. They're trapped. They're stupid. There's no way out of this. As Paul Tudor Jones said, all roads lead to inflation. Eventually, I would change my tune if we cut debt to GDP down significantly, if a new administration came in and played real hardball with the military and with entitlements. Yeah, and honestly, that would be what is necessary now. It's just, Trump doesn't need to get reelected. He can really do things now for the country without having to worry about reelection. Whatever he does, he has to do it fast. He's got 2 years till the midterm. He's got a majority in the House. This is the time. And he's going to come out, whatever you think of him, and again, sublimely ridiculous, he's going to come out running with the boxing gloves on. And he'll probably break a few plates in the china shop when he does that. But starting tomorrow and then this coming week, we're going to see some pretty drastic changes.
Gold prices have consistently served as a gauge of investor sentiment, mirroring concerns around inflation, interest rates, and global economic stability, trends that were evident throughout 2024. The price of gold began its ascent early last year, supported by ongoing inflation and persistent uncertainty in financial markets, reaching multiple record highs as it climbed. While the price saw some moderation toward the end of the year, it began to rise again in early 2025, with gold now nearing another record high, indicating strong investor demand. As we head into 2025, how do you expect gold to perform compared to other safe haven assets like the US dollar or treasury bonds? Your opinion matters. Drop your thoughts in the comments, hit the like button if you enjoyed this, and subscribe to stay informed on our journey together.